Over long periods, VGT has delivered outstanding returns. In some stretches, it has even beaten QQQ. That's why so many YouTube gurus call VGT the ultimate tech ETF. Some even suggest using it to replace QQQ as a core growth holding or selling diversified positions to go all in on this single ETF. And that's where the real risk begins. Not because VGT is a bad ETF, but because most videos focus only on the return chart and almost never explain the risks underneath. And when someone tells you to go all in on a single ETF, you're still going all in. In this video, we're going to do what most people don't. We'll break down 3 hidden risks inside VGT that are rarely discussed on YouTube. First, why VGT is far more concentrated than it looks. Second, which major big tech companies you're not actually owning, and why that already happened once in 2018. And third, why looking at past returns alone can quietly mislead long-term investors. VGT is a powerful tool, but powerful tools require discipline. And if you don't understand these risks, you may be taking on more exposure than you intended. Before we begin, this video is for educational purposes only, and it is not financial advice. Without further ado, let's start with what VGT actually is. Before we talk about the risks, let's be very clear about what VGT actually is. VGT is the Vanguard Information Technology ETF. It tracks a U.S. information technology index and invests only in companies classified as technology under GICS rules. That means VGT is a pure technology sector ETF. It currently holds a little over 300 stocks, and it is market cap weighted, so the largest companies have a very large impact on how the fund performs. One important detail many investors miss is that VGT is not limited to S&P 500 companies. It includes large, mid, and smaller technology firms, which gives the fund exposure to earlier stage companies that could become future industry leaders. VGT has a very low expense ratio of 0.09%, which is one of its biggest advantages. The fund is also very large, with around $130 billion in assets under management, so liquidity and tracking are not concerns. At the top of the portfolio, VGT is dominated by a small group of mega-cap companies. NVIDIA, Apple, Microsoft, and Broadcom together make up more than half of the entire fund. Below them are companies like Palantir, AMD, Oracle, Cisco, IBM, and Micron, each with much smaller individual weights. So while VGT looks diversified by the number of holdings, its performance is driven primarily by a handful of very large technology companies. VGT does exactly what it is designed to do. It gives you concentrated exposure to the U.S. technology sector, with low fees and very strong historical returns. Once you understand how VGT is built, the first major risk becomes clear: concentration risk. VGT is concentrated in 2 different ways. First, it is concentrated in one single sector. 100% of the fund is invested in technology companies. When technology is in favor, VGT can outperform dramatically. But when technology falls out of favor, VGT has nowhere to hide. That's exactly why VGT fell more than 30% in 2022. But the second layer of concentration is even more important. Despite holding more than 300 stocks, almost half of VGT is concentrated in just 4 companies: NVIDIA, Apple, Microsoft, and Broadcom. When you add them up, these 4 companies alone make up about 49.6% of the entire fund. Now compare that with Invesco QQQ Trust. To reach a similar level of concentration in QQQ, you need 9 different companies, even when you count Alphabet's 2 share classes as one single business. That means VGT may look diversified by the number of holdings, but in practice, it behaves much more like a mega-cap technology portfolio. In fact, during certain periods, VGT is more concentrated than QQQ. If one of these companies stumbles, VGT feels it immediately, and if several of them reprice at the same time, the drawdowns can be severe. This is not a flaw in VGT. It is a direct result of how the fund is designed. But it does mean that going all in on VGT is a much bigger bet on a few companies than most investors realize. Concentration risk is only part of the story. The second major risk is what VGT does not own. Many investors assume that a technology ETF automatically gives them exposure to all major technology leaders. But VGT does not hold Alphabet, Meta Platforms, or Amazon. These are not small omissions. Google and Meta control massive data, platforms, and AI distribution at global scale. Amazon, through AWS, is a core layer of cloud infrastructure that powers much of today's AI deployment. If a large share of future AI value creation comes from platforms and cloud ecosystems, owning VGT alone means you may miss part of that upside. And companies like Tesla sit entirely outside VGT as well. Tesla combines AI, autonomy, robotics, and large-scale manufacturing. That does not guarantee success, but it does mean that owning VGT alone guarantees zero exposure if that upside materializes. Now here is the historical context that most investors overlook. This has already happened once. In 2018, technology became so dominant that index providers restructured the entire sector classification system. At the time, technology accounted for roughly 26% of the S&P 500. As a result, Google and Meta were removed from the technology sector entirely and moved into the newly created communication services sector. VGT did not lose these companies because they failed. It lost them because the technology sector had grown too large. Today, technology is once again the largest sector in the S&P 500, now representing more than 30% of the index. That does not mean another reclassification will happen, but it does mean that sector definitions can change when concentration becomes extreme. And there is another layer of risk here. When a major company is reclassified out of the technology sector, the fund does not just lose diversification, it can lose one of its engines of growth. That is exactly what happened in 2018. When Google and Meta were removed, VGT became more dependent on the remaining mega-cap names. If something similar were to happen again in the future, VGT could lose exposure to another major driver of innovation without investors making a single decision. This isn't a mistake, it's a design choice. But many investors do not fully understand what they are not owning when they go all in on a single sector ETF. The third risk is more subtle, but it may be the most dangerous one of all: past return bias. Most YouTube videos compare VGT and QQQ using short and medium-term return tables: 1 year, 3 years, 5 years. On those charts, VGT usually looks better. Higher 1-year returns, higher 3-year returns, higher 5-year returns. That's why so many gurus confidently say VGT beats QQQ. But those charts show returns only. They don't show how much volatility investors had to endure, how deep the drawdowns were, or how difficult it was to stay invested. When we look at real investor behavior, the story changes. Using a daily dollar-cost averaging strategy from March 2009 to November 2025, VGT does not meaningfully dominate QQQ. Yes, VGT ends with a slightly higher ending value, but that extra return came with higher volatility. In fact, QQQ delivered better risk-adjusted returns, with higher Sharpe and Sortino ratios. Just to be clear about what that means. The Sharpe ratio measures how much return you earn for the total volatility you take. A higher Sharpe ratio means returns were achieved more efficiently, not simply by taking bigger swings. The Sortino ratio goes one step further. It focuses only on downside volatility, meaning it penalizes losses but ignores normal upside movements. In simple terms, Sharpe and Sortino tell you whether higher returns came from skill or simply from taking more risk. And in this case, QQQ compensated investors more efficiently for the risk they took. So the real comparison is not which line is higher on a chart, it's how much risk was required to get there. There is one more detail that return charts almost never explain. A meaningful part of VGT's historical outperformance came from companies that are no longer in the fund. Alphabet and Meta platforms delivered enormous gains from their IPOs up until the September 2018 reclassification. Those gains are fully embedded in VGT's long-term return history. But investors buying VGT today no longer own those companies. That creates a subtle distortion. People are comparing future expectations to a past that cannot be replicated using the same fund. And when you strip everything back, this is the implicit bet investors are making. If you believe VGT will outperform QQQ in the future, you are effectively betting that 4 companies, NVIDIA, Apple, Microsoft, and Broadcom, will collectively outperform a broader group of innovation leaders. That broader group includes Amazon, Tesla, along with Alphabet and Meta. That outcome is possible, but it's important to understand that this is not a neutral position. It is a concentrated bet on a smaller group of companies outperforming a much broader innovation cohort. This is why relying on past returns alone can quietly mislead investors. The future drivers of performance may look very different from the drivers of the past. So let's bring everything together. VGT is a great ETF. It offers low fees, deep liquidity, and strong long-term exposure to the US technology sector. But great performance does not mean low risk. VGT concentrates risk in 3 important ways. It concentrates exposure in a single sector. It concentrates returns in a handful of mega-cap companies. And it relies heavily on past performance that was driven by companies no longer inside the fund. None of this makes VGT a bad investment, but it does mean that going all in on VGT is a much bigger bet than most investors realize. If you understand those risks and size it appropriately, VGT can be a powerful satellite holding to supercharge your portfolio. But if you buy it based only on charts, rankings, or influencer soundbites, you may be taking on risks you didn't intend to take. Long-term investing isn't about finding the perfect ETF. It's about understanding what you own, why you own it, and how it fits into your portfolio. If you found this breakdown useful, give the video a like. It really helps the channel. And if you want more research-driven ETF analysis without the hype, consider subscribing. Thanks for your time today, and I'll see you in the next one.